Welcome to my YouTube channel. This is Most GFX, and today we have a new topic on order flows. Order flows is a concept that is derived on the smart money, and it is one of the 7 institutional reference points that we use so that we can know where the market is likely to go or where it's coming from. So we use order flows as entry points or areas of value where we take our trades from. So but first we have to identify them, and we have to define them for us to get to know how order flow works. So as we talk about order flows, these are areas where there is probability of the market by smart money grabbing liquidity before either continuing with a trade or maybe reversing from a trend. So, and we have two types of order flows. One, we have, remember, the market is in moves either bullish or bearish, so we derive those names from the trend of the market. So we have a bearish order flow and we have a bullish order flow. So today we have a chance to come and discuss them with you. So give me your ears and watch out, and have a pen and a biro and a notebook, sorry, and then we can dive in and start. So the first type of order flow, we call it bullish order flow. This is a scenario where the market is creating higher highs and higher lows. So when the market is creating a high like that, we have the market creates a high, that's a high. When it creates a new high, we call this is a high, and this is a higher high, because we call it this a high because it's the first high that was created. Then this is a low, and then when the market now pulls back and then breaks a new high, we continue with a higher high, and then this one we call it a higher low, higher low. So that's how the market delivers. So in a bullish market, we say that the market has that as it creates higher highs and creates higher lows. So we can define as a bullish order flow as the last series of sell candles, the pullback before the market breaks structure. Before the market breaks structure here, this pullback is called an order flow, which means buyers and sellers were putting orders against each other, and that's why we call it an order flow, because there was a tug of war. Sellers are trying to push the market lower, but it comes to a point where now buyers exceeds sellers' orders, and now the market breaks structure. That way, we refer this in a simple term for you to understand. We refer this to as an order flow, and this is a bullish order flow. Why? Because it's the last series of sell candles before the market broke this structure. That's how we define an order flow. So, and how do we are going to discuss on ways on how to trade those order flows, and I want to show you an example on a chart. If you check here very well, we have this chart, and as you can see, this is what we are calling an order flow, because if you can see these series of sell candles, remember the market pushed down from this level to this point, and then here is where the buyers were able now to push the market up and break this level. So here you have a break of structure. So if you are with me, this is what we call a break of structure. And then what do we expect? We expect an order flow to give us entries, and when the market now comes back, you see the market went up creating new order flow, but it had not tested this order flow. So when the market now comes back from this level, we are expecting that the market will push higher, so and either break this level or maybe react from that level. So that is what this is one we refer it to as a bullish order flow. As you can see, I've marked for you here. So we are saying that is a series of sell candles. So this movement from here to here before there was a break of structure is what we refers to as a bullish order flow. Remember, we are referring to it as a bullish order flow because the market is bullish, or the market is creating new highs. We see we have here high, we have a new higher high here, so and so on and so on. So that's how we define. So we're expecting that if the market now comes back to this level, we are able to take buys again, targeting the previous high that was created. We go to a bearish order flow. We say that as we say that bearish order flow, this is where now sellers get the energy to push the market lower and breaks a structure. So, and as we can define as, the market creates highs and lows. So we have a lower high and lower lows. So here the market creates a high, here the market creates a low, here we have a lower low, and here we have a lower high. So we define, as the market now moves down, what will give us a hint that we need now to sell. But first of all, thing we need to identify is our order flow, and our order flow is the last buying candles, the last sales of buy candles before the market breaks structure to the downside. So that's why we refer this one as a bearish order flow. Therefore, you need to identify the buying candles before there is a break of structure. So we are going to check how to look onto those order flow. If you go again, we look onto the bearish market, we see that the market creates low. Remember, this is a bullish market, so the market had this bullish order flow, then the market continued with the bullish order flow and broke structure again, and then here we have some magical. This bullish order flow failed to hold the price for us to buy here, and then the market broke that order flow, and then now we have a change of character to a downside. And then now this bullish order flow that failed to give us a bullish market, it's now that we are referring it to as a bearish order flow, because there is a break of structure to the downside, and then we will use that bearish order flow, the bearish order flow. Why do we refer to as bearish order flow? Because there is a change of character and the market displays lower, so we are using that order flow to give us a sell. So see how market did after it broke structure, broke this order flow, the market displays a little bit, created things we call liquidities and inducement, and then flashed lower. So from that order flow we had a displacement to the lower side. So we use order flows to know the direction of the market, and then if we know the direction of the market, we take sells or buys depending from where the order flow, from inside the order flow. So that is how we have a bearish order flow, guys, and that's how you identify a bearish order flow. So on the schematic, you check on the chart, you see I've marked you the sales of buy candles before there is a break of structure to the downside is called a bearish order flow. So if you didn't know, now you know. Go and try to practice as we check, and you see, as we have said, that the bearish order flow, we use it for price to give us entries to sell. Then let's go. We have something we call categories of order flows. This is very important, guys, because the first thing we have done, we have defined what are order flows. So the next thing we are going to do is to identify categories of order flows. So remember, the first time we have said we have defined order flows based on the structure of the market, be it bullish or bearish. Now we have come now to another concept where we now able to go deeper and now identify how do we now trade the order flows. What do we are looking for? First thing, we have mitigated order flow. The word mitigated also means tested. So if you see an order flow, you have to counter check on these three categories: mitigated order flows, unmitigated order flows, and failed order flows. The one that we will be using, there are two of them: unmitigated order flows and failed order flows. Let's dive in and check why do we use them. So guys, here we have mitigated order flows. In mitigated order flow, what do we mean? We mean that the market, after breaking this order flow, and we have a bullish order flow here, this is a bullish order flow, the market came back and tested this order flow. So when you find the market has already tested an order flow, that order flows tend to be useless again because it has already led to another break of structure. So when the market will come back to this level, we will not be looking for any opportunity to buy again from that level because that order flow has already been used. And that's why we say when an order flow has been mitigated, we tend to ignore it. We want to price to create a new order flow so that we can have a fresh zone for us to trade from. So never trade from a mitigated order flow unless you are waiting for it to be mitigated and then you start trading from it. The second category we have talked about unmitigated order flow. Unmitigated order flow is when the price has not already tested that level. You see, this level is very fresh. There was a break of structure here, and yet price has not come back to test this level. And now what we anticipate is that when sellers are coming to test this level again, remember this will be sellers coming to test this level, we are anticipating that we'll be having buys from that level. So we are anticipating that we'll be having buys from that level, and that is what we expect. So an order flow that has been mitigated is a tick for you to take trades from. So that is how we identify. I want to take you high. I don't want to take much of your time, but I want you to understand that the first thing we check on order flow is if it is mitigated or unmitigated. If we find it mitigated, we ignore it. If we find it unmitigated, that is a tick. So we are expecting to take buys from that level. The third thing we are going to check on the categories is what we call a failed order flow. A failed order flow is an order flow that had already given us, remember, a chance to buy, but what we did, as I told you earlier, if you see an order flow that has already been mitigated, don't trust it when price coming back to test it, because when price will be coming to test it, we might be expecting it to fail, and most of the time it does. So when price came back to test that order flow, see what happened. Price mitigated that order flow and failed. So here we have a change of character, a break of structure to the downside, and now we say that when an order flow has failed, it tends to give us another point to sell. So we're expecting buyers to push the market higher, and then we go back to sell. So the only order flows that we are constantly checking is unmitigated, sorry, and failed order flow. Those are the only levels that will give us sells or maybe buys from if the market is either reversing. So failed order flow, we are using them to trade reversals, and mitigated order flow, we are using them to trade continuation. So if you understand that, let's go to the chart and check what I'm talking about. So in this this is a pair GBP versus New Zealand dollar, and as we can see here we have a structure. The first thing we've said is to identify the order flow first, and as we can see that here we have an order flow where the market has come from this level and broke a structure. So the area that has been broken is this. Here we have a break of structure. So guys, as you can see, we say that first of all you have to identify if the order flow has broken structure, and then now we have a BOS, break of structure there, and the level that constituted the break of structure is what we are referring to as the order flows. So this is a bullish order flow because the market came, first of all, sold from this level and then went up and broke structure there. So this one we refer it to as a bullish order flow, and we're expecting when the prices come back to visit that order flow again, we'll be having push up. The market will push up to these liquidity areas available above this order flow. So we're expecting the market to break this level here, because the work of the order flow is to give us a chance to have either continuation or a reversal. If we go back down here, we're gonna check. We see we have a bearish order flow, and let's see. Here we have a bearish order flow. This one, we said that the bearish order flow is the last buy sell candles, series of buy candles before there is a break of structure to the downside. So that is a bearish order flow. Here we had a break of structure to the downside, and you see the market has come back to the order flow. First it tapped the order flow and then sold massively, then it came back again and sold again. So we used order flows to give us an entry point. Remember, we have other concepts that we need to combine for us to trade order flows the correct way. We have liquidity concept, we have inducement levels, and also we have premium and discount levels to watch out for. So if you can see here, we have liquidity areas. This was a liquidity created, this was a liquidity created, and that order flow would have worked well the first time. There we have that displacement, and then the best level to trade from was this area, because now it is a premium level and we are expecting sales, so we could have good risk to reward ratio so far. Even if you had an entry from that level here, if you had a confirmation level from that level and then you put your stop loss above that level, already you could have enjoyed 1:9 reward risk ratio if you had a confirmation from the lower time frame. So that is even more than enough, because not every time that price will go to your utmost target, or maybe sweep liquidity externally, because it can reverse due to other conferences that we are going to, or other areas that we are going to discuss as we move on. So that's how you identify those levels. Remember, we have said that a bullish order flow is the last series of sell candles before the break of structure, and you can see that now price is reacting to that order flow. It's now giving us a push up. And remember, we said that the bearish order flow is the last series of buy candles before there is a break of structure to the downside. So you see, after the break of structure to the downside, price came back to the order flow, gave us this displacement, to give us the second displacement. But remember, we had mitigated areas in these order flows and liquidity areas that were resting, that needed to be liquidated first, and then price give us this sell. So those are order flows, and we have said that order flow have their disadvantages, and that's why we are going to discuss the next topic on order blocks, which are also found inside an order flow. So guys, order blocks are the refinement. Remember, we talked about the disadvantages of order flows, and now the good news is that we are going to discuss another institution reference point, which is called order blocks, and we are going to see how we can use order flows and then then refine them to order blocks to have what we call optimal setups that will give us a good risk to reward ratio, that will give us a good criteria entry model, and also will reduce our stop losses, and we'll have a high probability of success in trading if you combine them. So that is the first thing we discuss. The second thing is order blocks, and it is coming in the next video. So stay tuned, share these videos with your fellow traders, and then we see how we can help each other. So knowledge shared is knowledge gained, so I don't feel guilty sharing this, and I don't feel jealous. I want you fellow traders to be successful like me in this journey. And welcome, and welcome again. Let's meet on the next video. In the meantime, have a nice time.